Dividends are one of the best ways to earn passive income without constantly monitoring your investments. But what exactly are dividends, and how can they help you build wealth over time? In this video, we'll break down the concept of dividends, how they work, and how you can start earning them by investing in dividend-paying stocks. Whether you're looking for extra income or a long-term strategy to grow your wealth, understanding dividends is key to achieving your financial goals. Let's explore how you can make money while you sleep with dividends. Today, we will talk about dividends explained, how to earn passive income. So before we get started, make sure to hit that like button, also subscribe to my channel. Did you know that some of the world's most successful investors built their wealth simply by collecting dividends? It's true. Dividends are a powerful tool for earning passive income. And in this video, we're going to explain exactly what dividends are and how you can start earning them to boost your financial future. Stay with us till the end for practical steps to help you begin your journey to passive income through dividends. 10. What are dividends? Let's start with the basics. A dividend is a payment made by a company to its shareholders, usually from its profits. If you own shares in a company that pays dividends, you'll receive regular payouts, typically in cash or additional shares. The amount you receive is based on how many shares you own and the dividend rate set by the company. For example, if a company pays a dividend of $1 per share and you own 100 shares, you'll receive $100 in dividends. Dividends are one of the ways companies reward their shareholders for their investment. While not all companies pay dividends, those that do often have a history of stable earnings and a commitment to sharing profits with their investors. The key takeaway here is that dividends are an attractive feature for investors who want a steady income stream without having to sell their shares. 9. Types of dividends. There are a few different types of dividends you might encounter as an investor. The most common type is cash dividends, where companies pay you directly in cash. These are typically paid out on a quarterly, semi-annual, or annual basis, depending on the company's dividend policy. Another type is stock dividends, where instead of cash, companies issue additional shares to their existing shareholders. This can help you grow your investment without having to purchase more shares. There are also special dividends, which are one-time payments made to shareholders, often when a company has extra profits or wants to reward investors with an unexpected payout. 8. Why do companies pay dividends? Now you may wonder, why do companies even pay dividends? After all, they could reinvest the profits back into the business, right? While that's true, paying dividends is a way for companies to attract investors, especially those who are looking for regular income rather than just capital appreciation. Dividends can signal to the market that a company is financially stable and confident in its future earnings. For investors, dividends are a way to receive passive income, even if the stock price is not rising rapidly. In fact, many investors use dividends to help fund their retirement or other long-term goals. Companies that consistently pay dividends are often seen as more reliable, which can make their stock an attractive option for income-focused investors. 7. How are dividends paid? Dividends are usually paid out in cash or additional shares, and they typically follow a regular schedule. To be eligible to receive a dividend, you need to own the stock on the ex-dividend date. This is the cutoff date when a company determines which shareholders will receive the dividend. If you purchase a stock after this date, you'll miss the upcoming dividend payment. 6. Dividend yield. What to look for? When you're investing in dividend-paying stocks, one important metric to pay attention to is the dividend yield. The dividend yield tells you how much a company pays in dividends relative to its stock price. You can calculate it by dividing the annual dividend payment by the stock price. For example, if a stock pays $2 per share in annual dividends and the stock price is $50, the dividend yield would be 4%. A higher dividend yield can be attractive, but it's important to consider the sustainability of the dividend. A very high yield could indicate that the company is under financial strain, or it could be a result of the stock price dropping. Always look for companies with a history of steady or growing dividends, as they're more likely to continue paying dividends in the future. 5. Reinvesting dividends for growth. One of the most powerful ways to grow your wealth through dividends is by reinvesting them. This means using the dividends you receive to purchase more shares of the stock. This strategy is often called a dividend reinvestment plan, DRIP. By reinvesting your dividends, you're buying more shares, which in turn can generate more dividends over time. This creates a compounding effect, where your investment grows faster as you continue to reinvest. Reinvesting dividends is a great way to take advantage of the power of compounding, which is one of the most effective ways to build wealth over the long term. Many brokerage accounts and dividend-paying companies offer automatic dividend reinvestment, making it easy to grow your portfolio without lifting a finger. 4. Best dividend stocks to invest in. When it comes to choosing stocks that pay dividends, it's important to look for companies with a track record of consistent dividend payments. Dividend aristocrats are companies that have consistently raised their dividends for 25 years or more. These companies are typically well-established and financially stable, making them a solid choice for long-term dividend income. Some popular dividend-paying stocks include companies in sectors like utilities, consumer goods, and healthcare, which tend to be more stable and offer reliable dividends. However, it's important to research each company thoroughly and make sure they have a solid financial foundation before investing. 3. Tax considerations for dividends. While dividends can be a great source of passive income, they're not tax-free. The tax rate on dividends depends on the type of dividends you receive and your overall income level. Qualified dividends, which are dividends paid by U.S. corporations or qualifying foreign corporations, are taxed at the long-term capital gains rate, which is generally lower than regular income tax rates. Non-qualified dividends, on the other hand, are taxed at ordinary income tax rates, which can be higher. 2. Dividends for passive income. The biggest appeal of dividends is their potential to provide passive income. This means you can earn money regularly without having to work for it. By building a portfolio of dividend-paying stocks, you can set up a stream of income that continues to grow over time. This is especially attractive for those looking to fund their retirement or supplement their current income without having to sell their investments. 1. Start earning passive income with dividends today. Now that you understand how dividends work and the power they can offer in creating passive income, it's time to take action. Start by researching companies with strong dividend histories. Consider how much you want to invest and explore different strategies for reinvesting those dividends. The sooner you start, the more time your investments will have to grow. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.